Hello and good afternoon, everyone. I am Kyle Judiel Fernandez, and I will talk about the topics on the following slides. Relevant risk terminologies is composed of three parts, in which two of them have been discussed already. So the part 3 is all about risk associated with financial institutions. What is a financial institution? A financial institution is a company engaged in the business of dealing with financial and monetary transactions such as deposits, loans, investments, and currency exchange. Financial institutions encompass a broad range of business operations within the financial services sector, including the banks, trust companies, insurance companies, brokerage firms, and investment dealers. So under this, risks are classified into two segments, which are financial and non-financial. Under the financial, first is the liquidity risk. Liquidity risk occurs when an individual investor, business, or financial institution cannot meet its short-term debt obligations. The investor or entity might be unable to convert an asset into cash without giving up capital and income due to a lack of buyers or an inefficient market. Next is market risk. Market risk is the possibility that an individual or other entity will experience losses due to factors that affect the overall performance of investments in the financial markets. So these factors could be in terms of currency, equity, and commodity. The third one is the credit risk. Credit risk is the possibility of a loss resulting from a borrower's failure to repay a loan or meet contractual obligations. It refers to the risk that a lender may not receive the owed principal and interest, which results in an interruption of cash flows and increased cost for collection. It involves counterparty, trading, loans, and guarantees under the commercial. Next is market liquidity risk. Market or asset liquidity risk is asset illiquidity. This is the inability to easily exit a position. For example, a person may own real estate but owing to bad market conditions, it can only be sold imminently at a fire sale price. The asset surely has value, but as buyers have temporarily evaporated, the value cannot be realized. Similarly to liquidity risk, it could be in currency rates, interest rates, and bond and equity prices. Next is hedge position risk, or what you call hedging. Hedging is a risk management strategy employed to offset losses in investments by taking an opposite position in a related asset. The reduction in risk provided by hedging also typically results in a reduction in potential profits. Hedging strategies typically involve derivatives such as options and futures contracts. Next is portfolio exposure risk. The higher the exposure to a particular investment in percentage terms, the higher the risk associated with that investment. For instance, a portfolio with 100% exposure to equities has a higher risk from equities than a portfolio with 60% exposure to equities and 40% exposure to bonds. Next is derivative risk. Derivatives are investment instruments that consist of a contract between parties whose value derives from and depends on the value of an underlying financial asset. However, like any investment instrument, there are varying levels of risk associated with derivatives. Next is accounting information risk. It is the relative ability of financial statement users to ascertain the valuation parameters of particular asset. Completeness and accuracy of information are part of this risk. Next is financial reporting risk. It is the risk that financial statements may be materially misstated prior to audit. Just like accounting information risk, it involves the adequacy and completeness of those financial informations. Let's move on to the non-financial segment. The first one is the operational risk. Operational risk is the prospect of loss resulting from inadequate or procedures, systems, or policies. It includes employee errors, system failures, fraud, or other criminal activity that disrupts business processes. Operational risk summarizes the uncertainties and hazards a company might face when it attempts to do its day-to-day operations with a given field or industry. It could be about the systems in information technology, customer satisfaction, human resources, fraud and illegal acts, and bankruptcy. Regulatory risk is the risk that a change in regulations or legislation will affect a security or a company. It includes capital adequacy, compliance, taxation, changing laws and policies. A change in laws or regulations made by the government or a regulatory body can increase the cost of operating a business, reduce the attractiveness of an investment, or change the competitive landscape. Next is environment risk. This is the risk that a certain business venture or activity will cause destruction to the surrounding natural environment. For example, if oil reserves were discovered in the national park, there would be environmental risk that exploiting the reserves might harm or destroy some of the park's wildlife. Under this can also be politics, natural disasters, war, and terrorism. Next is integrity risk. It is the threat to the reputation of, or the current or future threat to the capital or the results of a financial institution due to insufficient compliance with the rules that are enforced under or pursuant to the law. So in this risk, it is all about the reputation. Last is leadership risk. Leadership comes with many risks such as the possibility of physical harm, financial harm, reputation loss, failure, and accountability, but these risks can be mitigated. It includes turnover and succession. While there are many good reasons to shy away from taking on a leadership role, the world still needs more than great leaders. Moving forward, let's talk about the potential risk treatments. ISO 31000 suggests that once risks have been identified and assessed, techniques to manage the risk should be applied. These techniques fall into four categories. First, avoidance. Second, reduction. The third one is sharing. And last is retention. So, for first is risk avoidance. Risk avoidance is not performing any activity that may carry risk. A risk avoidance methodology attempts to minimize vulnerabilities that can pose a threat. An example would be not buying a property or business in order not to take on the legal liability that comes with it. Not entering a business to avoid the risk of loss avoids the possibility of earning profits. Next is risk reduction. It involves reducing the severity of the loss or the likelihood of the loss from occurring. Outsourcing could be an example of risk reduction if the outsourcer can demonstrate higher capability of managing or reducing the risk. Optimizing risk means finding a balance between the negative risk and the benefit of the operation or the activity, and between risk reduction and effort applied rather. Next is risk sharing. Risk sharing can be defined as sharing with another party the burden of loss or the benefit of gain from a risk and the measure to reduce a risk. For example, banks also use this practice to lend a big amount to individual large-size corporation, each bank supplying a portion of the loan funds. In these cases, both the profits as well as potential losses are shared between the two parties. Next is risk retention. It involves accepting the loss or benefit of gain from a risk when it occurs. Risk retention is the practice of setting up a self-insurance reserve fund to pay for losses as they occur rather than shifting the risk to an insurer or using hedging instruments. So, what is self-insurance? It is a system whereby a firm sets aside an amount of its monies to provide for any losses that occur or any losses that could ordinarily be covered under an insurance program. A business is more likely to engage in risk retention when it determines that the cost of self-insurance is lower than the insurance payments or hedging costs required to transfer the risk to a third party. So all risks that are not avoided are transferred or retained by default. A large deductible on an insurance policy can also be a form of risk retention. Let's go now to areas of risk management. As applied to corporate finance, risk management is the technique used for measuring, monitoring, and controlling the financial or operational risk on the firm's balance sheet. There are the most encountered areas of risk management. First one is enterprise risk management. In enterprise risk management, a risk is defined as a possible event or circumstance that can have negative influences on the enterprise. Next is the risk management activities as applied to project management. Project risk management must be considered at the different phases of acquisition. In the beginning of a project, the advancement of technical developments or threats presented by a competitor's projects may cause a risk or threat assessment and subsequent evaluation of alternatives. Next is risk management for mega projects. Mega projects, also called major programs, are large-scale investment projects typically costing more than 1 billion per project. Mega projects include major bridges, highways, railways, power plants, oil and natural gas extraction projects, public buildings, and defense systems. Mega projects have been shown to be particularly risky in terms of finance, safety, social, and environmental impacts. Risk management is therefore particularly pertinent for mega projects and requires special methods and special education that have been developed for such risk management. Next is risk management of information technology. IT risk is a risk related to information technology. This is due to an increasing awareness that information security is simply one facet of a multitude of risks that are relevant to IT and the real-world processes it supports. Cybersecurity is tied closely to the advancement of technology. Last is risk management techniques in petroleum and natural gas. For the offshore oil and gas industry, operational risk management is regulated by the safety case regime in many countries. Hazard identification and risk assessment tools and techniques are used by organizations and regulators in mining, aviation, health, defense, industrial, and finance. A simplified framework for an enterprise-wide risk management process is as follows. The top management's involvement is to set management policies, establish context, set limits and tolerance, and etc. Whereas, under the risk management system, the focus is the oversight activities. It defines goals and objectives, roles and responsibilities, common language, and oversight structure. There are the steps of risk management process. Step 1. Assess risk, identify, source, and measure. That is to ensure that processes capture all the business risk. Step 2. Develop or design action plans. Reduce, avoid, retain, transfer, and exploit. That is to ensure that all available tools and methodologies are used. Step 3. Implement action plans. That is to review the effectiveness of the plans as well as checking its capacities. Step 4. Monitoring and report risk management performance. That is to review and evaluate regular reports on performance. And for the step 5, continuously improve risk management capabilities. That is to evaluate recommendations for improvement. And this process is repeated as long as the risks need to be addressed in the enterprise. The Security of Exchange Commission requirement relative to enterprise risk management of publicly listed corporation. The board should oversee that a sound enterprise risk management or ERM framework is in place to effectively identify, monitor, assess, and manage key business risks. The risk management framework should guide the board in identifying units or business lines and enterprise-level risk exposures, as well as the effectiveness of management strategies. Risk management policy is part and parcel of a corporation's corporate strategy. The board is responsible for defining the company's level of risk tolerance and providing oversight over its risk management policies and procedures. Also, Principle 12 states that to ensure the integrity, transparency, and proper governance in the conduct of its affairs, the company should have a strong and effective internal control system and enterprise risk management framework, meaning it is to strengthen the internal control system as well the enterprise risk management framework. In other words, the Security and Exchange Commission requires corporation to maintain and observe the assessment of the risk management. That's all for my report. I hope you learned something. Thank you.